The stock market offers abundant rewards for you. So, never forget to take the most beautiful gifts along your investment way, dividends. In today's video, we'll uncover how to easily find dividend stocks and why they should always be a part of your portfolio. Let's get started. Dividend stocks provide you with a passive income at regular intervals, regardless of market fluctuations. Some companies pay their dividends annually, others semi-annually, and some, especially U.S. companies, even quarterly. Furthermore, dividend stocks offer stability as their prices tend to be less volatile. The fact that a company pays dividends also indicates that it has a healthy financial foundation. Lastly, dividend stocks help you benefit from the power of compound interest. This can be achieved by regularly reinvesting the dividends paid out into the stock itself over a long period of time. As a result, your wealth grows exponentially over time. Let's move on to the selection criteria for dividend stocks. First of all, the dividend yield should generally be above 5%. This percentage indicates an attractive dividend payment from the chosen company. However, make sure that the yield is not in the double digits, as this could be a warning sign of financial instability. Next, you should pay attention to the dividend history. Ideally, the company should have been paying dividends for at least 10 years. Additionally, the company should have increased its dividend annually during this period. Indications of further dividend increases in the future further enhance the overall attractiveness. Next, you should look at the payout ratio. It should be around 40% to a maximum of 80% of the company's profits. This means the company should return a reasonable portion of its earnings to shareholders through dividends. However, it shouldn't exceed 80%, as the company should also retain a portion of its profits for reinvestments and further growth. Finally, the company should demonstrate financial stability. This means that its earnings have consistently increased over the past few years, the equity ratio is greater than 30%, and the level of debt is low. To identify suitable dividend stocks, we'll use the stock screener on the Stock Analysis website. You can find the link to the site in the video description. Once you open the link, you'll be forwarded to the homepage. From there, navigate to the stock screener under the Stocks category to access the filter overview. By default, the overview is loaded without any filters, but you can customize these based on your preferences. To do so, click on Add Filters and select the criteria we discussed earlier. The selected filters will then be clearly displayed. Let's go through the most important filters. Dividend yield. Set this to over 5% to ensure attractive dividend payments. Dividend growth. This should be intact for at least 10 years, meaning the dividend has been consistently increased annually over that time. Cumulative dividend growth over the last 5 years. This should average above 3%, indicating a sustainable increase in payouts. Earnings growth. The company's earnings should have been positive over the past 5 years. Earnings per share growth. EPS growth over the last 5 years should also be positive, meaning it exceeds 0%. Payout ratio. Set this to a maximum of 80%, ensuring the company retains enough capital for reinvestments and future growth. Debt to equity ratio. Ideally, this ratio should hover around 1, with lower values being preferable. Lastly, there's the filter for the country, which allows us to categorize company headquarters based on their geographical location. Once the filters are set, a list of matching companies will appear. For example, if I select the United States as the country, I get 3 companies that meet our criteria. One of these is Enterprise Products Partners. To view more details, click on the company's symbol. This will take you to the company overview, where you can find detailed information under the Dividends tab. For instance, this company pays an annual dividend of $2.1. Below that, you can also view the most recent dividend payment dates. You can apply the same process for other countries. For example, select United Kingdom as the country and apply the filters. As a result, you'll see companies like NWF Group, which also meet our criteria. To diversify your portfolio, it's a good idea to choose companies from various developed countries. This way, you can end up with a handful of stable dividend payers that perfectly align with your investment goals. Let's create an example calculation for the company Enterprise Products Partners, which we identified earlier with the stock screener. Let's assume you invest $10,000 at a stock price of $33.75 per share. This would allow you to purchase approximately 296 shares. You multiply the 296 shares by the annual dividend of $2.1 per share, which results in an annual dividend payment of $621.6. For this example, we'll assume you have a tax exemption in place that fully covers this amount, meaning the dividend is paid out to you net of taxes. If you reinvest the $621.6 dividend and the stock price remains at $33.75, you can purchase an additional 18 shares. This increases your total number of shares to 314 shares. Before reinvesting, your annual dividend was $621.6. After reinvesting, your new share total of 314 would result in an annual dividend of $659.4. This is because the 18 additional shares also pay the annual dividend of $2.1 per share. This example demonstrates how a dividend strategy allows you to benefit from the power of compounding. While the effects may seem modest in the early years, over a period of 10, 15, or 20 years, the impact becomes exponential. By consistently reinvesting dividends, your wealth and dividend income can grow significantly, potentially leading to explosive long-term results. We'll close the video with a few final useful tips. First of all, you should focus on specific industries when looking for dividend stocks. These are primarily found in sectors like energy, telecommunications, insurance, and the grocery industry. Additionally, if possible, you should place a so-called reinvestment order with your broker. Your broker will typically notify you a few weeks before the dividend payment, giving you the option to choose between receiving the dividend as a payout or reinvesting it back into the stock. Whenever possible, you should opt for reinvestment. However, it's important to note that with this method, you can usually only purchase whole shares. Keep in mind that the dividend strategy is designed for a long-term investment horizon. You should commit to this strategy for 10, 15, or even 20 years to fully leverage the power of compound interest and significantly grow your wealth over time. Lastly, you should include approximately 5 different companies in your portfolio, ensuring they come from various industries and different countries. This way, you'll be well diversified and benefit from stable and attractive dividend payments over the long term. That brings us to the end of this video. The dividend strategy offers many advantages, which we've discussed in detail. I hope you can successfully use the approach shown to identify suitable dividend stocks. Remember, the magic of the dividend strategy lies in its ability to harness the power of compound interest over a long period, allowing your wealth to grow to unimaginable heights. Therefore, dividend stocks should always be a part of your portfolio. I wish you great success in building your wealth. See you in the next video.